If there is an area in which the finance, accounting, and investment manager must not fail, it's in the area of investment appraisal. Organizations do exist to commit capital into projects and therefore make profits. But before this commitment is made, it's very important that they do their due diligence and investigation into the cash flows and also into what the project will look like in the nearest future. This is a critical moment in the life of any project, any organization, any investment, and this is a critical area of performance management and performance appraisal, in which no finance person wants to fail and no organization wants to fail. And when we thrive in this aspect of our work and world, the sky is just the starting point, not even the limit. So welcome to GJAMES Associate channel. My name is Gbenga Olatunji FCA, and we will be looking at investment appraisal, capital budgeting. Before we can invest, capital expenditure must go into it. So all these topics are related, and we are going to be establishing ourselves in these areas. In this video, we are going to establish and introduce ourselves to methods of investment appraisal, in which we are going to be talking about accounting rate of returns. We are going to be talking about net present value. We are going to be talking about payback period. We are going to be talking about discounted cash flow, in which NPV and IRR are part of what we need to look at. And we are going to define what those methods are and their peculiarities and their similarities, their differences. When it's best to use accounting rate of returns, which relates basically to, it's like ROCE, return on capital employed, but it uses accounting profit. We are going to equally introduce ourselves to the cash flow basis, in which we'll be talking about payback period. Is a method that complies with cash flow reasons. We are going to be talking about the discounted cash flows methods, in which we are going to be measuring on MPVs and IRR. What is MPV? What is IRR? What is the difference between IRR and ARR? Those are the things that we will be discussing in this video. Also, we will know the features of investment projects. That is, when we are talking about investment project or capital appraiser, what are the things that we should expect from it that we come up? Like when we are talking about investment projects, one of the things we'll be talking about is we are talking about an asset that we are looking forward to procure, which may have residual value, which may have useful life, which we may intend to hold for a longer period. We are just introducing ourselves. We've not gone into it anyway. We are going equally to understand the basis for making an investment decision, and simply is by appraising it very well. Then we commit ourselves into it as an organization and we monitor it. Much more is coming up on GJAMES Associate channel on investment appraisal. Capital expenditure, we are going to look at it, of course. Capital budgeting, all these things are interrelated. So let us, without any further ado, take a pen and paper and go into our dashboard and begin to put all these things down one after the other. As a rule of thumb, capital appraisal should be only invested, or capital cash flow should only be invested in. Projects should only be invested in if they have these two or meet these two criteria. Number one, the investment risk must be acceptable, must be within the limits of the organization's approved limits, acceptable risk. Also, they are expected to provide a suitable financial returns. The projects we are appraising must bring back suitable returns to the organization. Having said that, basically for exams purposes, exams dwells more on discretionary capital expenditure rather than essential capital expenditure or spending. Both could be examined, but more questions will be on discretionary expenditure, which majors on new business initiatives that are intended to develop the business and make a suitable financial returns to the organization. But the essential capital spendings basically is for replacement purposes, for worn-out assets and maintenance of operational capability of the organization. Having established ourselves in that, we need equally to understand that when we are talking about investment appraisal, the individual projects that are formally approved must only be invested in. So capital cannot be committed to a project even though we've appraised it, but until it is formally approved. So it must be formally approved and be included in our capital budget. Also, new ideas for capital projects, we must ensure that the appraisal criteria are equally suitable for the financial returns that the organization expects, and also the capital committed must be within the limits of the organization capital commitment that we can make. It is important, especially on the finance manager's side, to ensure all this is done so that our appraiser and our work will not actually be seen wrongly or be perceived wrongly. So investment appraisal and capital budgeting now, before we move on to the features of investment project. Generally, it must be generating capital return for the organization. When we are talking about capital return to the organization, it may take years before the organization begins to recoup back. But in studying it in our appraisal and visibility check, we must have ensured even the payback period. That is one of the methods anyway. So also in appraising, we must ensure evaluated every aspect possible of the project. We must examine it, have a record of it. Also, we must forecast relevant cash flow relating to the project. The project must be within the strategic objective of the organization. Also, when we are implementing projects, it must satisfy compliance criteria for deciding whether the project will earn a satisfactory return on investment. Last but not the least, that we must ensure when we are appraising capital expenditure is that we must ensure and put monitoring of performance in place for the investment project. We don't just drop money into a project without looking back. And don't forget, we are studying performance management. That is critical. When we are now talking about the features of any investment project, what are the things we are going to have and the characteristics? Number one, the project will involve purchase of an asset, investment into one capital project that has expected life of several years. That is important to note too. And that is why sometimes I said that when we are especially in net present uh, value valuation, we are going to be looking at 5 years annuity in cash flow and the like, and all these are pointing to the character of a project. Also, it involves large sum of payment and money or cash flow, cash outflow, cash investments. Also, an asset is being purchased which may have residual value. Sometimes it may not, but majority of the time it's going to have a scrap value, and it equally have some long useful life. Another feature is that some capital projects will need another capital, which we can call working capital, to ensure that what the milestone we actually want to reach, we are able to achieve them before returns begins to come into our pockets as an organization. The methods of investment appraisal. Accounting rate of returns. Accounting rate of returns dwells on profitability, and it checks the rate of profits or profitability of the organization against the capital outflow. It's just like return on capital invested, in which the profits or the net profit is checked against the capital employed into the organization or into the project. Just see it that way so that you will not confuse it with any other method of project analysis and appraisal. Once you know that ARR is like rows, you won't get it wrong or mix it for any other method of appraisal in the exams. When we are talking about payback period, payback period simply looks at how many years will it take us to have our capital injected back to us. Then we can make profit on top of our capital that we had earlier invested. Basically is a method of division. We divide what we can make, which we've projected for, against the year that we've projected for, and know for how long it's going to take us. I'm trying to think about which accounting ratio it can relate with. Maybe any per share or dividend yield, around that. Another method that we can think about is the discounted cash flows, and we can talk about two aspects of that: the NPV that we call net present value, and that of internal rate of return, which is IRR. Basically, when we are talking about net present value, basically in NPV, we are talking about the present value. Present value of two things: the present value of our costs and the present value of the income or the return. Basically, we want to net it off and know what's the present as a now, the net, which is the profitability equally, we give to us using the net of the present value. When we are talking about internal rate of return, the organization has the acceptable level of return in percentage majority of times. Then we check the project's profitability against what the organization had predetermined. So the expected return against the established or the standard internal rate of return. Basically, this are the summary of what we need to understand about them. If we lay it to hearts as simple as I laid them down, it is not confusing in their approaches when we are calculating them. We are going to go into the advantages and disadvantages and calculation of accounting rate of return, payback period, and the discounted cash flow, under which we'll be talking about the net present value calculation and the internal rate of return method 2. We are going to calculate them. If you are yet to subscribe, go and subscribe please to GJAMES Associate channel. You are helping somebody to be reached out to when you do that, and encouraging else. My name is Gbenga Olatunji FCA. For those that are just viewing us for the first time, say you are welcome. Please subscribe and click all as the notification so that anytime we actually upload a new video, you will be the first to be notified. From GJAMES Associate, we are followed to life. Next, we are going to be calculating, and we are going to be looking at the advantages and disadvantages of all these methods that we've spelled out. We are value to your businesses.